Coming up, a big lift in consumer confidence. Domestic airfares are higher and the Trump trade continues. All of that next. It is your daily 10-minute business and finance news wrap for this Tuesday, the 12th of November 2024. The Australian share market fell today, but only just by 0.1%. I'll have the details with Adam Dawes from Shaw and Partners in a few moments. But first, to some good news about the Australian economy. And it would appear consumers are becoming more confident about the outlook for the economy as they worry less about the prospect of higher interest rates and feel more secure in their jobs. The Westpac Melbourne Institute Consumer Sentiment Index rose more than 5% in November to be only just below the 100 mark, which separates pessimists from optimists. Why? What does it say about the economy and the outlook for interest rates? I spoke with Matthew Hassan, senior economist at Westpac.
It's showing a clear improvement. We had sort of some initial signs of this back in October when rate rise fears really died down, and we saw some initial lift in sentiment off the very weak levels that we'd seen for the previous 2.5 years. In November, that momentum has continued and extended. We're now only 5 points below that neutral level where optimists balance pessimists. Generally, you'd sort of refer to that as maybe cautiously pessimistic, but I think it's not quite that bad. When we look at the components of the index, all of the forward-looking parts of the index are now positive, so that people are optimistic about the future. Current conditions are where we're still getting a drag. Family finances are recovering, but it's still fairly gradual, and assessments of time to buy are still fairly downbeat. So the problems around the cost of living and the purchasing power that consumers are struggling with are still there, but their forward view is quite upbeat now. So there's an optimistic tone, I think, to expectations, and there's light at the end of the tunnel, I think, now quite clearly for consumers.
Can we go through why do you think this is happening? Because it comes at a time where the Reserve Bank is still refusing to cut interest rates. We're seeing interest rates fall around the world, and then we also had the US presidential election. Any of that have an impact?
Absolutely. And what was quite interesting is that we saw very clear shifts over the course of the survey week. We have the survey in the field over the week ending November 11. So we have some readings that were before the RBA's November policy decision, and then some that came through after the US presidential election was declared. What we see is at the start of the week, confidence was even stronger. It was closer to that 100 level, around about neutral. And following the RBA decision, yes, they left rates on hold, but they still talked about, they weren't prepared to rule out further rate hikes. That didn't seem to have any impact. So consumers are just not worried about further rate hikes at this stage. What we did see, though, is after the US election results came in, there was a wobble. We saw sentiment drop over the day following the US election results, and then sort of recover a little bit into the end of the week. That sort of variation is worth about plus or minus 5 points on the overall sentiment read. So it is quite important as to how we assess that post-election softening, whether it's a temporary initial reaction that we subsequently recover from, or whether it's a longer lasting setback. Either way, though, I think we're still looking at a recovery profile. Amongst those surveyed after the US election result, the average reading was just over 91. So it's still pushing towards that neutral level, and definitely improved on the 75 to 80 reads we had when we were right in the thick of the cost of living crisis, and the slowdown in inflation wasn't really showing through very clearly.
We know that many retailers aren't doing too well at the moment and struggling. What do you think it means for the sector as we approach that important Christmas period?
Look, I think it's a little bit more hopeful. We actually have a specific question in our November survey asking consumers about their Christmas spending plans. And this year's responses were just a touch below average. So around about 35% of consumers are looking to spend a little less than last year. But on average, when we run this question, around a third usually say that. So it's about a regular response. You contrast that with the last two Christmas periods. Going into the Christmas period, around 40% of consumers were looking to spend less. It was an austerity Christmas, and they were cutting back on spending. This year, I think we'll be about level, maybe slightly ahead on last year's Christmas spend, which is good news for retailers. At the moment, it's pretty uncertain. We've seen tax cuts haven't done much so far. Consumers, on our estimates, have only spent about 20 cents on the dollar of their tax cut boost to incomes. So it's sitting there in savings. This is telling us that some of those savings are going to get deployed. They'll target those sales periods, the Black Friday, Cyber Week, and also the leading to Christmas and then Boxing Day. So I think there's opportunities here for retailers. It's a little bit better than the difficult years, the last couple of years we've seen, but still about average rather than a real gangbusters year.
And I know that this is one of the reports that the RBA looks at when they discuss interest rates, right? What do you think they'll be thinking when they see this?
Well, look, it will have some bearing on the RBA's thinking. We would tend to highlight that this positivity that we're starting to see, or less negative reads on sentiment that we're starting to see, are still very much dependent on inflation coming back under control, giving some scope for some interest rate easing next year. If that doesn't pan out that way, it's likely we'll see some fragility to consumer sentiment, and we could see some loss of ground. So from where we sit, this looks to be more about a stabilization in the consumer rather than they're about to rush out and start spending. So for the RBA, I don't think this is a particularly threatening result, and it still depends on that inflation side of things tracking in line with expectations at the moment.
That is Matthew Hassan there from Westpac. Now let's go to the aviation industry, where it would appear domestic airfares have risen ever since Rex stopped servicing capital cities. The ACCC says the average airfare on all major city routes increased by more than 13% from the end of July to September. And that also coincides with some major sporting events and school holidays. The number of seats on services between metropolitan cities also fell despite stable passenger numbers leading to fuller flights. The Consumer Watchdog says currently there is no domestic route serviced by more than two major airline groups, with some routes like Adelaide to Melbourne seeing ticket prices surging by as much as 95%. For more, I spoke with ACCC Commissioner Anna Brakey. Anna, how would you describe the state of competition in the domestic aviation market at the moment?
We have a really concentrated domestic aviation market. Over the last few months, we have seen two airlines exit. Bonza has exited and Rex has exited the major city routes. They're the kind of, Brisbane, Sydney, Melbourne, Adelaide, Perth type routes. And what that means is that the Qantas Group holds nearly 2/3 of the market, and Virgin holds about 1/3 of the market. That's a really concentrated domestic market.
We talk about airfares because the average airfare, according to your latest report, of all major city domestic routes rose 13.3% from July, when Rex exited those major city services, through to September. How much would you attribute that to Rex leaving those cities? Because it also comes at a time of higher demand, right?
It did come at a time of higher demand. We saw some intercity teams make grand finals, and that meant that there was more travelling public, and it's also holidays. So there is no doubt that we're going through a period of increased demand. But what we know is that when there are more airlines contesting a particular route, we see lower airfares. And as we saw Bonza and Rex exit some of those routes, we did see airfares go back up.
It may sound like a very blasé or simple question, but what can be done about it?
What we want to make sure is that the conditions for entry of new airlines and the ability for small airlines to grow are there. We want to see good access to Sydney Airport. When you're travelling on those major routes for an airline, the domestic airline industry really needs good access to Sydney Airport. The government has made some changes or has announced some changes to access to Sydney Airport, and we are very pleased that there will be improved conditions. That might take a little while to work its way through, but it is important that new and growing airlines can get a foothold in the market. We'd also like to see better regulation of the airports themselves. The airline industry or the aviation industry is a really important industry to the Australian economy and to the travelling public. It is one of our compliance and enforcement priorities, and we will be continuing our focus on it.
And finally, what about airline performance? Are they becoming more reliable?
We have seen a bit of an improvement since those really terrible times during COVID. We're heading back to pre-COVID levels. We saw a little bit of a spike from Rex, who are usually a pretty good performer, as they cancelled those flights when they withdrew from the major city airlines. We are back to seeing Rex with better than average performance, and at the moment, the Qantas brand is above average performance, above average cancellations and late flights.
It's Anna Brakey there, the ACCC Commissioner, and we did hear from Qantas today telling a Senate inquiry that it does not hoard flight slots at the airport as Parliament considers tough fines for anti-competitive behaviour. And in a statement, the airline refuted the ACCC's report, saying fare increases for particular routes does not reflect average fares customers are actually paying.
Now, Market Day on the SBS On The Money podcast.
The Australian share market fell today, but only just. The S&P ASX 200 down 0.1%, 8,255. For more, I spoke with Adam Dawes, a senior investment advisor at Shaw and Partners. Adam, so shares in the US hit another record, yet the ASX is down today. Why?
Yeah, it's a little bit interesting, isn't it? Because obviously we've seen losses in gold, iron ore, energy stocks, and they're certainly dragging down the ASX today, which obviously we've got a lot of resource stocks in our portfolio or is in the market. Mining stocks like BHP was down 2.1%. Iron ore prices overnight slipped around 2%. And it's nearly at that $100 level as well. And we saw energy stocks also slip around 1% today. But the real reason is, and you asked me why, the real reason is that the US dollar has started to rise, and that's not good for commodities, which is bad for our market.
How are you viewing Trump's impact on the market, both locally and the US? Because you mentioned the dollar starting to rise, but there's a different type of currency that's doing super well at the moment, and that's Bitcoin, which continues to hit record levels.
Yeah, so the so-called Trump trade has continued to march on. We certainly saw Tesla rallying more than 7% last night in the US, and the US dollar inching up close to a one-year high. And that has also allowed Bitcoin to jump more than 9.5%, topping around US $88,000 in early trading today. So it's certainly looking like that Trump trade is going to continue through at least the next 6 months.
Any major company? That's Adam Dawes there, Senior Investment Advisor at Shaw and Partners. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.